market commentary that we're seeing is that there's testing times ahead with so much uncertainty about pertaining to Europe and those European currencies coming under significant pressure. It's hard to disagree with a statement like that at this stage of the game, one would assume.
No, absolutely, Alishia. In fact, our view is that this is going to be a very testing year for the euro. We see it going as low as 115 to the dollar, and that should happen by about Q2 of this year. And that's really because the sovereign debt crisis, now in its third year, doesn't seem to be much further to a final conclusion than it was, say, a year ago. And so we think that those fears are certainly going to continue to weigh on the euro. We already had yesterday Fitch warning the possibility of a breakup in the region and the possibility of a downgrade in France's sovereign credit rating. So certainly things in the euro area are still not settled, and that's definitely going to be another key theme for this year.
In that context, we have got safe haven assets like the US dollar getting fresh support. So what are you looking at on the euro dollar front when it comes to trading ranges that you've got pegged out on your end, Nomvuyo?
Well, certainly I wouldn't want to take a stab at another volatile currency trading pair, but as I said, the overall movement that we're seeing in that currency pair is for the euro to go down as far as 115 to the dollar, and that's going to be quite a sharp depreciation that we're seeing from current levels.
I ask because we've been saying all along that dollar rand strength will depend on euro moves as opposed to dollar moves, more than anything else. So that then says that the local unit is set for testing times ahead.
Well, absolutely. I'd agree with the idea that the unit is set for testing times ahead. We do see the rand weakening against the dollar. But interestingly, the rand's correlation with the euro is not stable and certainly isn't constant either. So for this year, what happened last year, rather, was that the euro managed to hold its own against most currencies. And that was really because while the central banks like the Fed and the BOJ were quantitatively easing in their respective economies, we didn't have the same reaction by the ECB, and that kept the euro well supported. Headed forward, we do see that there's an increased chance that the ECB will cut rates. In fact, we expect them to cut rates by 25 basis points today. There's also the increased possibility that they could engage in quantitative easing, and that should all help to bring the euro down this year. So we could have a combination of the rand weakening against the dollar, but remaining relatively firm against the euro this year.
When it comes to that euro situation, I mean, we've got the head of Fitch's sovereign ratings having urged the ECB to beef up its buying of Eurozone debt to support Italy and, prevent the Eurozone's collapse. Is that a path you see them venturing down? Because along with that, expectations are that we're supposed to hear some rhetoric about them talking about governments having to increase their contribution to bailing out entities like Greece.
Well, certainly now that the ECB has a new head, Mario Draghi does seem to be a little bit more open to the possibility of engaging in sort of extraordinary measures to help support the Eurozone, and that's in contrast to his predecessor Trichet. So as I mentioned today, we are expecting the ECB to cut rates by 25 basis points. We are expecting them to continue to cut rates to reach the benchmark interest rate of 0.5% by the end of this quarter, and we certainly can't rule out the possibility that they will also help try to support struggling debt markets by mopping up bonds as well.
Well, locally, we've got manufacturing data that's being anticipated. Nomvuyo, the rand likely to momentarily react, traders saying, to that data that's being anticipated later today before investors turn their attention to these global developments once again. What are your expectations on that front?
Well, we're pretty much in line with consensus. We expect that there was probably a pickup in manufacturing activity in November, but year on year we're not expecting anything magical. I think the consensus forecast is for year-on-year growth of 1.3%, and that's quite fairly disappointing given the size of the manufacturing sector in our economy. So if the data comes in there or thereabouts, there shouldn't be a huge reaction from the rand. Of course, the risk is that the data does disappoint, and then that would probably incur further currency weakness. And at this point, we think that the major risk is that the data would disappoint rather than surprise to the upside.